Physical Gold Fund presents The Gold Chronicles with Jim Rickards and Alex Stanczyk. Insights and analysis about economics, geopolitics, global finance, and gold.
Hello, my name is Alex Stanczyk, and welcome to episode 92 of The Gold Chronicles. Today is March 27th, 2020. I have with me today my friend and colleague, Mr. Jim Rickards. Welcome, Jim.
Alex, great to be with you.
Before we dive into today's podcast, you can access an archive of podcasts and transcripts going back several years at www.physicalgoldfund.com/podcasts. If you watch this podcast on YouTube, please take a moment to subscribe and like, as well as feel welcome to comment below. Let us know your feedback on today's podcast. All right, so for those of you who are new to our podcast, Jim Rickards is a well-known and respected expert in geopolitics and a number of other subjects. He has a ridiculous number of degrees and professional credentials that I won't get into. You want to go to the jamesrickardsproject.com. You can learn more about that. He's also a Wall Street Journal and national best-selling author. The first time I kind of ran across Jim was around 2010, I think. I think I saw you on Bloomberg, and you were talking about gold. I was thinking to myself, who is this guy, this Wall Street pedigreed guy talking about gold? And I'm thinking, like, isn't that forbidden by Wall Street code? You're not allowed to talk about gold. What's going on with that? So later I picked up Jim's book, Currency Wars, and I realized very quickly I really need to get to know this guy. So if you haven't read Jim's books, I encourage you to do so. His books include Currency Wars, The Death of Money, Road to Ruin, my personal favorite, The New Case for Gold. Yeah, I'm biased. And Aftermath. So, Jim, the audience is by now already familiar with coronavirus, as well as that we are probably in the opening salvos of the global financial crisis 2. Just being honest, calling it what it is. So we don't have to rehash a lot of that about how we got here. Let's kind of discuss where it goes from here. Like, seriously, how bad is this?
It's bad. I think that's pretty well known. The question is how bad, what's the right way to think about it? How long will it last? What will the impact be? Those are all big open questions. We can address all of them to some extent, but I think bad is a good place to start. By the way, Alex, thank you for mentioning my books. I'm very grateful for that. The funny thing about the books is they were, there's some history, there's some analysis, there's some science. The readers generally like them, but mainly there was a lot of prediction and warning. Like, here's what's going to happen, here's how it's going to happen, here's the impact, etc. And over the years, I do a lot of public speaking and interviews and so forth. And one of the questions I get most frequently is, okay, Jim, I hear you. I understand what you're saying. I agree. Could you call me the day before and let me know, and I'll sell my stocks and get some gold and all that? And I just say, well, a couple of things. Number one, I'm not going to know the day before. I can tell you what's coming, give you some idea of the order of magnitude, but I won't necessarily know that day. If somehow I did know the day, I'd probably be a little busy myself. But beyond that, what are you waiting for? In other words, if you agree with the analysis that something like this is going to happen, why would you wait until it happens? Because it will be too late. By the time everyone wakes up, 30% of your wealth in stocks will have disappeared, which did happen in the last 3 weeks. The price of gold will soar, and we'll get into this a little bit more. But right now, with physical gold, if you're not the central bank of Russia, the price doesn't matter. You can't get any. Eventually some will, and I can explain that in a lot of detail, but, call a dealer and try getting some right now. You can't do it. Unless you're dealing with a well-established relationship. So the irony is, you warn. Everyone's like, thank you, but I'm going to keep buying stocks. Then it happens and like, oh, gee, I should have listened or whatever. That can't be helped. Human nature is, you can't, human nature is what it is, meaning you can't change it. So when you tell people or suggest to people, you ought to buy gold, it was 1,100. Yeah, 1,200. Yeah, 1,300. Yeah, 1,400, 1,500. All of a sudden it hits 1,600. Everyone's like, get me some gold. And guess what? It's exactly what I said. Dealers are not returning calls. The U.S. Mint is back ordered, not taking new orders. Royal Canadian Mint is closed. Swiss refiners still have some output, but they can't ship it to the United States because of all the transportation bans. By the way, Brinks, which has the vault near JFK, that's one of the largest depots of gold in the world outside of, the Federal Reserve or the Bank of England. They're working half shifts because of coronavirus. Brinks has a backup facility, or not backup, but an alternate facility in Salt Lake City. They got hit by an earthquake. And they closed that because they have to assess the earthquake damage. So, when it rains, it pours. Earthquake's not correlated to coronavirus, but, Murphy's Law, if I ever catch Murphy, by the way, he's in trouble. But Murphy's Law is you get an
strangle this
earthquake.
guy, Murphy, right?
Well, as soon as I find him, he's in big trouble. But
so you know what's amazing to me about all this is that we've had this global run on metal, right? It's the whole system's cleaned out.
Right.
And in the fact that the Swiss refineries have shut down makes it even worse. And we probably talk about that more later. But what is fascinating to me about that is how small a fraction of the human population understands what's happening right now to have cleaned out the metal complex. Like in my estimation, I'd say it's way less than 5% of the population are the ones buying the gold.
Oh yeah,
If
well
that's
maybe
the case,
maybe 1%. Yeah.
If that's the case and we've already cleaned out the metals complex, what happens when we start to have problems in the US dollar and people really get switched onto it? That just blows my mind where that could go.
Yeah, you're absolutely right, Alex. And we've said this all along. I said, when you most want your gold, you'll be least able to get it. It won't be about price anymore. And that's another interesting disjunction. People say, well, the futures price and the physical price have diverged.
Yeah.
The answer to that is yes and no. The futures price is what it is, but it's not gold. They're paper contracts linked to the price of gold in some way, but they kind of set the price of gold. That's not gold. But if you want to get in physical bullion, a dealer will do spot plus commission. So spot will, refer to COMEX. It is what it is. But the commission, the discount dealers are kind of 2% or more. Another dealer might be 4%, which is higher, but, maybe there are good reasons to be dealing at the higher commission price. But now the commissions are 10%, 15%.
Oh yeah, they've blown completely out. The
Correct.
numbers are completely.
And so, if gold's 1,600 and the commission's 10%, add, 160, so that's 1,760 for your gold. So is it two different prices? Well, all in, yeah. When you count the commission, it is. Even though the spot plus commission, like, oh, by the way, what's the commission? Well, 10%. That's 5 times the normal commission. So there is this disjunction, even though the way they quote it, they go spot plus commission, but check out the commission. But that's a reflection of the fact that you can't get it at all. Interesting legal footnote. If you're a dealer or the mint or anybody selling physical gold, it's actually illegal to sell the gold for delivery more than 28 days forward. And the reason for that is if your delivery is more than 28 days forward, you're classified as a futures contract. That's the difference between the physical and so I can deliver to you in a week or 2 weeks, but if I deliver you in 2 months, technically I'm a futures contract off exchange, so I'm probably violating the Commodity Exchange Act. Now, I think people are, not me, but I think some regulators are turning a blind eye to that for the moment. But even dealers who take your order might tell you have to wait a month or longer to get the gold, which is another way of saying
at retail, it's going to be, there's not going to be, the whole complex is cleaned out. So here's a question. And this came up from one of our viewers is how do we get back to price discovery? Because it's broken. Like the price discovery in the market's broken. One of our colleagues in the industry recently said it's discovering the price of something, but it's not physical gold. What is it? Like, how do we get back to normal?
Well, yeah, again, any contract you make, whether it's a futures contract, an ETF, an unallocated forward under the LBMA rules, a phone call and an order, a guy takes your order, but I'll get back to you. None of those are gold. None of those are physical bullion. They're contracts, and contracts can be terminated. People can claim force majeure. People can just not show up. We're in an environment where you don't just have to worry about the price and the availability. You've got counterparty risk. How do you know the person you're buying the gold from is going to be there when you give them your credit card number? they disappear. I'm not suggesting that's widespread. And most of the dealers, I know some very honest, reliable dealers out there, but they're the ones who will tell you the truth. They're the ones who will say, well, thank you, but there's no gold. So the answer is sometimes you don't. I mean, sometimes you don't get back to normal price discovery, and we're seeing that right now in the stock market. So we all know what the stock market's done the past month. It's dropped over 30%. Little rally a couple of days ago, but back down again. You get these big up days, down days. That is certainly down. Even accounting for the rallies, it's down about 30%. So what's going on there? Well, the stock market is trying to reprice.
Well, as far as price discovery just in the gold markets, I think people are wondering, how do we fix this? And like at the refinery level, from my perspective,
yeah,
I'm really curious to see how this is going to work out, because in my experience, my entire time in this industry, we've never seen the refineries close, ever. In fact, as far as I'm aware, they didn't close through wars. They didn't close through the London Gold Pool. This is like a really unique event. So I'm really curious to see what's happening when they open. And I suspect it's all going to be deals based upon people that they know, who they trust, just
correct.
Like you said. They're going to be wondering and looking at whether these people are going to stay solvent or not, their counterparties. And they're going to be doing basically direct deals, I think. So we're going to end up, when I say we, I'm talking about physical gold fund, we're probably going to end up with refinery, what we call refinery spot pricing. That's going to be based upon their book.
Right.
Not the OTC market, not the futures market, not any of those kind of things.
Correct. But you're one of the funds that has longstanding relationships, positive relationships, trusted counterparty, and you can pick up the phone and they'll take your call. But if you're calling from the blue, or they don't know you, or you're the fund that started yesterday, they won't take your call. They would say, why waste our time? And without mentioning names, you and I met with the head of precious metals at one of the biggest refineries in the world. And this was several years ago, not last week or last month. And what we were told at the time was that this particular refinery was working 24 hours a day. They were working triple shifts. They could not meet the demand. China wanted more, but they said, okay, we'll sell a lot to China, but we've got our long-standing customers, Rolex or Cartier or whoever needs the gold. We can't cut them off. So that was at capacity, turning down orders 3 years ago. And now, as I say, they will not pick up the phone unless it's you or Central Bank of Russia or some very established account. And even then, it may be hard to get. So when things get back to normal, it may not be anytime soon, because this feeds on itself. There's a recursive function. So people who kind of didn't want gold or turned up their nose at gold for years suddenly want gold. Oh, I can't get it. Well, now I want it more. So it feeds on itself.
The whole world right now.
And one thing I've observed is that mining output is flat. I'm not saying it's disappearing, but mining output has not increased in 6 years. It's running about the same level, several thousand tons a year, but it's not going up. So when you have fixed supply and skyrocketing demand, the first week of economics, you learn that makes the price go up.
Yeah, price is going to have to rise to clear, especially with the miners are shutting down. There's a lot of miners shutting down because of coronavirus.
Correct.
That's only going to feed into that lack of supply in the system. And so basically, it's all going to have to come from either scrap or people who own it who are willing to sell it, which means right now, probably a lot of people aren't willing to, and the only thing that'll change that is the price.
Correct. And with the liquidity squeeze, and this thing is the thing. When I say thing, I mean starting with the pandemic, but it runs through the economy. Capital is scarce. I mean, the Fed's printing trillions upon trillions of dollars just to keep the lights on. I mean, they're not. You can call it the helicopter money if you want. It isn't really. They're just trying to keep the commercial paper market, the muni market, the corporate bond market, currency swaps of foreign central banks, the repo market. They're trying to keep all those things open.
Yeah, they're trying to prevent ICE 9.
Correct. They're trying to prevent ICE 9, but this is not like extra money. This is just a massive amount of a liquidity injection just to keep things from getting worse. So where's the capital going to come from miners to expand? They might have very attractive opportunities, but Capital is going to be scarce. Coronavirus is an impediment. There's a transportation shutdown. Borders are closed. So yeah, you can't. I spoke to not just an expert. I mean, I spoke to a major gold dealer a few days ago. Again, like yourselves, he is a Meaning Physical Gold Fund. He's a guy who is well regarded, plugged in, so his phone calls do get returned. And he told me a lot of things we're discussing right now. But he said, if you have a dealer, he said, your dealer might have a little bit of inventory, and if he has some, he might sell to you out of inventory, but he's not replenishing, and they'll all run out of inventory very soon.
Yeah, I can see that. Okay, so let's move on. Next topic. Something that I think a lot of people are wondering about. Last week, the unemployment claims came in at 3.38 million for the week.
Right. Serious
question. Is this the next Great Depression?
The answer is yes. I think we're already there. I mean, the data is going to trickle in over the months ahead. So, April 28th or somewhere around the end of April, we'll get the first quarter GDP. Bear in mind that the first quarter ended March 31st. So you had an awful March, but January and most of February were okay. So that'll be bad, but it might not look as bad as it's going to get. But April, is going to be horrific. And second quarter GDP, but we're not going to get that number until the end of July. But we'll have plenty of data between now and then. The data is already coming in. You just mentioned one of the data points. By the way, that figure was 3.2 or 3.3 million initial claims last week. The previous high was 700,000.
Yeah.
So this is not just, it got a little worse. It's like, no, this is 4 times or almost 5 times the worst on record. That's how bad it is. So you're going to see GDP drop. These are all estimates, but at least 5% or more in the first quarter. Bearing in mind you had a good couple months in that quarter, it's going to drop. Take your pick, 20% maybe in the second quarter. We've never seen anything like this since the Great Depression. So you got to take 2008 and get it out of your head. That's not the baseline. That's not what's going on. This looks like 1929. That's where you have to go to see anything like this. What happened in 1929? Well, from 1929 to 1932, July 32 specifically, the Dow Jones Index dropped 89%. Let that sink in. It's down 30. What if it has another 60 percentage points to go? That's what happened then. Unemployment went to the mid-20s, around 25%. World trade shriveled, et cetera. Banks were closed. Just president woke up one day and closed the banks, and they remained closed for 8 days. So that's, I'm not saying exactly those things are going to happen. I'm saying that's how you have to think about this in terms of what's going on right now. With one big difference.
More. Go ahead.
Yeah, well, the difference is that everything I just described about 1929 played out over about 3 to 4 years between 1929 and 1933. What we just saw played out in about 3 weeks.
Yeah, so everything right now is accelerated.
Right. So there's never been anything like this. So if you
so speaking of that, let's talk about what's happening in logistics supply chains, because every day this goes on, there's all kinds of small and medium businesses throughout the U.S. economy and the world economy too. But I'm talking right now just about the U.S. For example, most of the U.S. is in voluntary lockdown. Everybody's doing the stay-at-home thing, and small businesses are closed. Nothing's being moved around unless it's essential services, et cetera.
Right.
There are, I don't know how many small and medium businesses that every day this continues, they're closer to bankruptcy.
Correct.
A lot of these businesses will not be starting up again when people are around, are moving around again. We're going to lose huge portions of logistics supply chains throughout the entire economic system in the United States. What's worst case scenario with all that?
Well, let's kind of do worst case and maybe a slightly better case, but I think the worst case deserves a lot of consideration. I saw an interview the other day with a couple very famous chefs, as Wolfgang Puck and another famous chef, and of course they're pleading on behalf of the restaurant business. But they said, what do you have to understand about restaurants? It's not just the bartenders and the servers and the people in the kitchen. They all get laid off. They close the doors and revenues are zero. But it's that supply chain. So the the farmer, the fisherman, the butcher, the truck drivers, all the people who supply the restaurants, they've all gone to zero because the restaurants closed. So the ramifications of this, and that's just one, it's an important part of the economy, but that's just one slice. Take that, doctors' offices are closed, dentists, lawyers, accountants, manufacturers, on and on. I mean, there's no need to recite the list because the list is basically everything you can think of in the economy.
So everything and everyone. Yeah.
So that's the bad part. Now, here are the questions. Here's how I think one needs to think about it. You have to say, well, how much will it drop? And the answer is unprecedented in U.S. history. Number two, and this is important, when will it come back? How long will this last? Big question. And number three, what will the recovery look like? Will it be the famous V where it goes down sharply but comes back sharply? Or will it be a kind of what they call a U where it goes down, pokes along at the bottom, and then comes up? Or the worst outcome maybe is the L where it goes down and then it just stays there. So you have some growth, but not much, and you don't get back to trend. And so, in kind of thinking about that, you have to ask yourself further questions. So we have huge losses, got it. Are these permanent or are these temporary? And let me make that distinction. So, my wife and I usually go out for dinner on a Friday night. We didn't go out last Friday. We're not going out next Friday. So those dinner bills or whatever are lost to the economy. Now, by, who knows, hopefully May, June or something, things get back to normal. We'll feel like going out to dinner. But when we go out to dinner, we're not going to have 3 dinners. We're going to have 1 dinner. So the 2 dinners are permanently lost. That's a loss to the economy.
Right.
It never comes back. If I was out to buy a car and I decide to put that off and I go out in August because things look better and I buy the car, that's a timing difference. That's a temporary difference. The GDP still got the car, but it was shifted from the second quarter to the third quarter. Okay. So what's the mix? Well, 70% of the U.S. economy is consumption, and 70% of that is services rather than goods, rather than manufactured goods. So 70% of 70% is 49%. So 49% of the U.S. economy, those losses may be permanent. Not all of them, but I would weight the losses more to the permanent side than the temporary side, even though some of it, will be timing differences. That's the first thing. The second thing, and I just got off the phone with, I love talking to people who are twice as smart as I am, and I just got off the phone with somebody in that category. But she's working on a.
That even possible? I didn't know that was possible.
They're around. I try to find them. You always want to be the dumbest guy in the room if you can.
Twice as smart? I don't know that's possible.
Okay. Yeah. But they're working on what's called continuity of the economy. This is a little bit more on the national security side. But I was explaining the same thing we're explaining to our listeners now in terms of permanent. But you remember 2009, 2010, what were we hearing from the government and Larry Kudlow and CNBC and all that? Green shoots. Remember the famous green shoots?
I remember the green shoots.
Well, we never saw the green shoots. It was more like brown weeds. And it was the U.S. economy never got back to the pre-2008 trend. From the trend growth in all recovery since 1980, which is a particularly favorable period, but is 3.2%. But trend growth since 2009 to 2020, so 11 years, is 2.2%. So we've been growing. This is not Trump versus Obama. I mean, there's actually very little difference between the Obama economy and the Trump economy in terms of what we're talking about. 2.2% growth, a full percentage point lower than the pre-2008 trend. So we never got back to trend. We grew. Yeah, okay, it was a recovery technically, weakest recovery in U.S. history. And if you think a percentage point is not a big deal, try applying it to a $20 trillion economy compounded over 10 years. It's a very big deal. 1 percentage point, we're talking about $5 trillion of lost wealth. That's the difference between 3.2 and 2.2.
Which is nothing in comparison to what's just been lost. And what will probably
and that's my point. That's my point. Even when we have a recovery, so what do you hear now? They're not using green shoots anymore, but Secretary Mnuchin, Larry Kudlow is now a government official. They're talking about pent-up demand. There is no pent-up demand. Again, the car example maybe, but not the movies and the restaurants and the other services that were concerts and et cetera that were skipped. There's no pent up demand for that. You're not going to get 2 or 3. You're going to get 1 when you get back to normal. So
Okay.
now we could be looking at the kind of recovery where, yeah, okay, we'll hit bottom and we'll start growing again. But the growth could be sort of 1.8%, 1.9%, not even the old 2.2%. So, well, hey, we'll coin a phrase on this podcast. This is the new normal, which is not great. And so between and as far as stimulus is concerned, so we've seen the Fed. So they've blown past the old benchmarks. The Fed balance sheet today.
Well, let's come back to that in the CARES bill, but I want to cover that towards the end of the podcast, and we'll also talk a little bit about what people can actually do, because I know people are really interested in that right now. And I know a lot of people are very concerned. Some people are angry. Some people are frightened. So we'll get to that. There's 2 sort of things that I kind of want to cover before we hit all that. One of them is, I saw a really cool interview the other day. There was a guy by the name of Jeff Bloom. I believe he's a technology billionaire of some sort. He wrote a book called The Price of Tomorrow, and he stepped through in this interview some kind of socioeconomic consequences for the way the Fed has been operating and the government's been operating. The fact that every time we have a problem, instead of letting capitalism just do its thing, we basically inject all kinds of money and blow the bubble even bigger, right? So the moral hazard of that, it's called, and I've heard this term coming up more and more on FinTwit. I know you do Twitter. People who follow us, a lot of them do Twitter. It's called financialism instead of capitalism, which is basically crony capitalism, where central banks print. The people closest to the money get richer. Everybody else gets poorer. That's step 1. Step 2, this further drives the wealth inequality gap, causing a greater divide. Step 3, people end up voting for those politicians who are saying it's not your fault, it's their fault, whoever they are.
Right.
It ends up breaking society because of the polarity, and it leads to possibly revolution or war because people are that upset. You have any thoughts on that?
Yeah, I think that's a very good analysis, and I think that is next. It's my model for this. I spent a lot of time working with complexity theory. I didn't invent it; it was invented in the 1960s, but I'm one of the pioneers in applying it to capital markets where it has not been used. And so you have a complex dynamic system. They will throw up what are called emergent properties, or things that surprise you, that even if you knew everything in the system, which you never do, you couldn't infer what comes next. But sometimes complex systems crash into each other. And my model for that is March 2011, the Fukushima event in Japan. So what happened? There was an earthquake, an underwater earthquake. So that's one, tectonic plates or one complex dynamic system. So there's the earthquake. It caused a tsunami. It didn't have to, but it did. So that energy was transferred to hydrology, which is another complex dynamic system. It could have hit an isolated island, but it didn't. It crashed into a nuclear power plant. That's radioactivity is another complex dynamic system. You had, in that Fukushima plant, you had 3 meltdowns and 2 hydrogen explosions. Okay, and then what happened next? The Tokyo Stock Exchange crashed because they were worried about, obviously the shutting down the Japanese economy at the time. So my point is, tectonic plates or seismology, hydrology, tsunamis, radioactivity in a nuclear power plant, and capital markets are 4 separate, normally uncorrelated complex dynamic systems, each one of which is extremely challenging to analyze. But here you had 4 of them crashing into each other in rapid succession. We're seeing something like that right now. So the pandemic, epidemiology, interesting science. It's like half biology, but once you get past the biology, it's really just applied mathematics.
It's a lot of math, right?
It's a lot of math, right? So I don't claim to be a biologist, but I can do the math. So that's one complex dynamic system. Crashes into the economy, which is a complex dynamic system. But now that's affecting politics. This will have an impact on the presidential election. And beyond that, you say, okay, what's next? Then you get into social disorder, social collapse. And I'm seeing signs, again, I tell my national security colleagues, watch South Africa and watch Mexico. They're big countries. They're important economies, emerging markets, but they're important economies. uncomfortably close to being failed states. Uh,
Oh,
we, you
Mexico.
know, hey, we got like Venezuela as a failed state. Yeah, Syria is a failed state. Yeah,
Yeah,
got it. But what about Mexico? It's already more than halfway there with the cartels. And look at the collapse in the price of oil, which they're utterly dependent on. Throw in a coronavirus, and
sure. Overwhelmed
throw
hospital
in
systems.
overwhelming migration from Central America. Now where are you? So
Yeah,
there are these geopolitical aspects of it. Not to mention the whole China-U.S. relationship, which is I would say beyond fractured. I would say we're on a there's a new Cold War. There already was, and now
sorry. Yeah, there's
that's made a lot
verbal
worse.
war drums going on right now.
Correct. So my point is, you can't. You have to look at the economy, of course you do, but you can't stop there. You have to go beyond that into. I mean, I'll give a kind of a funny sounding example, but anyone, I grew up in New Jersey. I have a lot of family there. I go back a lot, but anyone who's from New Jersey knows that it's two states. There's North Jersey and South Jersey, and they're completely different, and they don't like each other, and everyone's okay with that. But there's some coronavirus showed up in Cape May, which is as far south as you can get, and that's where my family lives. But they did the forensics, and they found patient zero. Patient zero was a New Yorker who had a summer house and got out of New York, went to his summer house, and started to spread the virus in an otherwise remote part of the state. Well, they're just about ready to get out the pitchforks. They're like, "Hey, you New Yorkers, stay where you are. Don't bring the virus down here." They want to close the Egg Harbor Bridge. Well,
Yeah.
hold on. So you're talking about different states worried about border type issues. I don't want to overstate it. Maybe it's partly humorous at this stage, but not really. And
Did
again,
you see there was a video I saw where there are all these migrants moving through Turkey. I don't know if they're Turkish or not. Maybe they're coming from,
they're Syrian.
okay, and they're trying to penetrate the Greece border. And
Correct.
it looked like a movie, or it looked like a scene out of a medieval movie. They're carrying siege ladders to the wall in
Right.
groups, and
Right.
they're covered. They're doing it under cover of smoke, and it looks like a. And I'm thinking, when you said Mexico, that's the image that came to my mind.
Yeah.
Is
Well,
Mexicans trying to cross the border in
we're not that
mass?
we're not that far from that. What's interesting about that is that the Syrian migration through Turkey into the European Union predates the coronavirus uh, pandemic, not by much, but kind of contemporaneous. But it wasn't caused by that. It had to do with Turkey was upset at NATO for not backing them up against the Russians in Syria. So they said, okay, if you don't want to support us and et cetera, and, we're clamping down on the Kurds and all that, we'll just turn on the immigrants faucet. Now the Syrians
Yeah.
can get into Turkey if Turkey lets them, but then Turkey abuts Greece and Bulgaria and the European Union. Well, the European Union has this Schengen Accord, which says once you get into an EU state, you can go to any other EU state without border controls. So it's not about getting into Greece, it's about getting into Germany. But
Mm,
once you get to Greece, you can go to Germany, no questions asked.
right.
So it starts out that Turkey wants to flood or threaten to flood the European Union with Syrian immigrants because they're not happy with the treatment vis-a-vis the Russians. But all of a sudden, you're like, well, hold on, who's counting? Who's doing coronavirus tests on the Syrian refugees? And by the way, Europe is breaking down in the sense that all of a sudden nationalism is back. The French are saying, hey, we got to close the border with Spain, or Germany's saying we got to close the border with Austria. Well, so they're putting up border walls, at least legally, inside the EU, leave alone what you're talking about, which is a wave of Syria. So it's getting nasty out there. But again, it's an example of how these response functions and complex dynamics start crashing into each other. And that's
Right.
exactly what's happening.
Okay, so switching gears. Excuse me. Over the years, you and I have talked a lot about full spectrum warfare. So
Right.
for those people who are not familiar with that term, full spectrum warfare means financial, biological, cyber, social engineering, one might say, kinetic warfare, all of the whole spectrum. And I'm gonna run a quick scenario by you, Jim. It's been bothering me. Um, So you have the United States in a very vulnerable situation. You've got I'm just going to be straightforward. I know I'm not the only person thinking about this, and I'm sure in the Pentagon they've gone through all these scenarios already. But you've got a virus that's crippling the American population. We've got the financial crisis, which is crippling America financially.
Right.
We've got a prolonged shutdown of businesses, which is going to wipe out substantial portions of the U.S. logistics system, because once those companies are bankrupt, they're just out of business.
Right.
Like if I were to create a really like worst case scenario in if the Russia OPEC oil war or price war drops the price low enough, the U.S. shale industry is underwater, they all start going bankrupt. That's how the U.S. is oil independent, basically. So then the U.S. is no longer oil independent. Hospitals are completely overwhelmed because of coronavirus. Economies crashed. Logistics systems are busted. If I was China, Russia, and maybe even Iran, would that not be a perfect time to go kinetic? Or maybe even wait until U.S. service members are infected, sick as dogs, and then go kinetic? There's been reports of naval Russian Navy activity near the UK is heightened. There's a lot of heightened movement of troops and whatnot. Why is this it's a perfect opportunity. It's probably the weakest the United States has ever been in my lifetime. What are the good reasons China wouldn't want to do something like that, or Russia? Or are there good reasons they would? Are there good reasons they won't?
Kind of both, but a lot of good reasons they would. It's already happening, Alex. For example, the other day it was reported that one of our aircraft carriers, which means an entire aircraft carrier group, which has all kinds of support vessels and destroyers and cruisers and submarines and all kinds of stuff with it. And forgive me if I get the name wrong. I think it was the Theodore Roosevelt, but if it was another vessel, so be it. But it was, we don't have that many. We have about 11 aircraft carriers. These Enterprise class. Now we're getting the Nimitz class. Now we're getting the new Ford class carriers, although they're only, I think there's only one in service. But we only have about 11 of these aircraft carrier groups. At any point in time, you're from the Navy, so you know this better than I do. 2 or 3 of them are in, they're getting maintenance. I mean, they're in dry dock, or they're laid up, or they're getting maintenance. 1 or 2 are on kind of R&R. You got to give the crews a break. So there are really only about 4 of them that are deployed at any one time. And you always have 1 in the Western Pacific, 1 or maybe 2 in the Persian Gulf, and 1 somewhere else, maybe in the Med. Well, the one that's in the Western Pacific, and I believe it was the Theodore Roosevelt, they had a huge outbreak of coronavirus. So they sent it first to San Diego, and then they said, "No, we got to get out of here." That vessel is going to Guam, but it's out of service. It's offline. They got to basically test the entire crew. They have to clean the entire vessel. And again, these aircraft carriers are, you can put the Titanic in the hold. I mean, that's how big these things are. So the point is, so our primary aircraft battle group for the Western Pacific is offline. I'll leave it to the Navy to get something else out there. But if you were China, what better time than to mess with Taiwan? And you say, why would you do that? Well, there's every reason, well, not every reason, it's just a case that the Chinese have been lying about the impact of coronavirus in China. They've got their numbers. There's something, by the way, in economics, but it applies elsewhere, called Lockhart's Law. And Lockhart's Law says, when a metric becomes the object of policy, it loses meaning as a metric. In other words, once you have a number and that number becomes important to how people perceive you, you start manipulating the number, and analysts can no longer rely on it. So it's the case right now. I use the Johns Hopkins dashboard. China has about 81,000 reported cases of coronavirus. The US just passed them. We're around 83,000. Well, I trust the U.S. number. Certainly, everyone agrees they're more infected than we know because we haven't tested everybody. That's fine. But I think the U.S. number is highly accurate. The Chinese number is just a lie. Very good reason to believe that number could be 10 times higher. Like they might have 800,000.
Or 100 times higher.
Right. And there's a basis for that. It's not just speculation. It's funny, when you squash the truth in one place, it tends to pop up somewhere else. You just have to be looking. The Chinese Ministry of Telecommunications, like, who cares? Like, what do they have to do with coronavirus? But they report monthly cell phone use. has been reliably reported that Chinese cell phone use went down, or the phones online went down. 21 million cell phones went out of service last month. And the Chinese were like, oh, that's because people weren't paying their bills. I mean, those people are either dead, or they're disabled, or they're in hospitals, or they've been rounded up one way or the other. So that gives you a better idea of the order of magnitude of this. But my point is, China has come up with a number, and curiously, it doesn't go up much. They knew the U.S. would pass them. That's easy. And now they can point a finger at the United States and say, hey, we did a better job than you guys.
Yeah, I don't
It's
know
all
that
propaganda.
I don't know that anybody believes China's numbers.
No one believes it. But see, this is how, this is now sort of taking intelligence training and bringing it into capital markets can be very valuable. I always say, if you had to solve a problem and you had all the data, a smart high school kid could do it. The hard problems are ones where you don't have all the data and you have to use inferential methods and other techniques. But on February 23rd, I believe it was a Sunday, and that week, February 24th to the 29th, that was the first week the stock market really crashed. It went down 3,000 Dow points that week. Now, since then, we've seen it go down 3,000 in a day, but that was the first shock wave, if you will. Well, the Sunday before the Monday opening, I sent a tweet. I said, the stock market has been holding up and going up, which it was prior to that, based on improvement in the Chinese data. But everyone knows the Chinese data is a lie.
Right.
Which is it? And since the data was a lie, it meant the stock market had to crash. I said the stock market's going to have its day of reckoning. And I based that on the fact that we were getting good data out of Italy. And it was horrific. I trust the Italian data, not the Chinese. So my point is the market was rallying on Chinese lies. The lies were being revealed by reliable Italian data. And once that sank in, the market was going to crash. That's exactly what happened. So you can use, your MIT economists don't like to use anecdotal data. I'm like, sorry, there's another name for anecdotal data, which is the truth. It's like, here's what's happening at street level.
It's eyewitness data.
Eyewitness data.
It's another way to say it.
Yeah, just because you can't put it into an MIT closed form equation doesn't mean it doesn't count. So
not a peer-reviewed paper, but it's somebody who's seen it with their own eyes.
Right, but that's what we have to do in highly uncertain times with very imperfect data. But the point is, getting back to the original thread, which is China's in much worse shape than anyone realizes, much worse shape than they admit, and it's a tried and true technique of dictators that when you're in trouble, go start a war because it gets everyone's mind off it.
Yeah,
and since the U.S. aircraft carrier battle group has just been disabled, what better time to start a war?
Yeah. Okay. Next thing, CARES bill. I love this thing. Have you read it?
They throw these names around. Is this the big $2.2 trillion package that was
just seems like it's full of pork. Like I've only seen parts of it because I haven't read it.
Yeah, I haven't read just be clear, I haven't read the actual bill. It's 1,100 pages. I've read some very good expert summaries. I have a pretty good idea what's in it. There's a fair amount of pork. But here's what I would say. A lot of what's in there, well, first of all, just a quick footnote. It's $2.2 trillion, but in that $2.2 trillion is $425 billion to recapitalize the Fed. If one of my books, I believe it was The Road to Ruin, which came out in 2016, I had a dinner with one of the members of the Fed Board of Governors. I said, I think your bank's insolvent, which it was at the time, because meaning the Federal Reserve was insolvent, because at the time interest rates were a little higher, which meant they had mark-to-market losses on their 10-year notes. They don't mark-to-market, but if you were a hedge fund, if you did, they would be insolvent. And she said, no, we're not. And I said, he said, no one's done that work. I said, well, I've done it. I think others have done it. And she kind of harumphed and said, well, central banks don't need capital. So here's a governor of the Federal Reserve sitting, we're sitting next to each other at a small dinner. And she said, central banks don't need capital. I said, well, tell that to the American people. But it turns out they do need capital, and they're getting $425 billion from the Treasury. But here's the point. Because they're a bank, you pop in $425 billion of capital, they can leverage it 10 to 1. That's $4.2 trillion of additional balance sheet. So take the $2.2 trillion, knock it down to 1.7 for the Fed money, but then add 4.5 5 trillion approximately for the Fed money printing. This is a $7 trillion helicopter drop, not
Yeah.
2.2. This is $7 trillion of new money. But here's the point. Forget stimulus. There's nothing about this that stimulates. This is just to keep the lights on.
It's filling holes. It's filling
yeah,
holes. That's all.
filling holes. So, okay, the Fed has sequentially guaranteed or propped up or bought out commercial paper, money market funds, corporate bond market, muni market, primary dealers, central bank currency swaps with ECB, Bank of Japan, et cetera. So the Fed is doing what they need to do to keep the lights on, but none of it is stimulative. It just keeps it from getting a lot worse. As far as the money the Treasury is spending under this bill, all right, 50 billion to the airlines, 10 billion to the post office. Go down the list. Cruise ships, theme parks, auto industry, et cetera. They're all getting some money, but it's just to make up the losses. There's no stimulus. There's no net new spending in this. This is, oh, well, you close your business. Well, here's some money. The Small Business Administration is just handing out money, but
Right.
but there's a condition, which is if I give you the money and you fire your workers, you have to pay it back. But if I give you the money and you don't fire your workers, you can keep the money. It's a grant. Well, okay, that makes up for a couple of weeks of payroll, maybe a couple of months. So you can pay your rent for the next 2 months. I'm not saying that's unimportant, but it's no more than 1 to 2 months of make good pay. None of it brings the economy to a higher level. It just keeps the economy from sinking to an even worse level. What happens when that runs out? Now, again, your V people, you're down and up. I don't see it. But one of the reasons I don't see it is, first of all, what we talked about before, which is a lot of these losses are permanent, not temporary. You're never going to make them back.
Right.
But two, and this is where the economists fall down, you can't, they don't take into account the psychological aspects, meaning you can give people money, but what if they don't spend it? I mean, some people have a high marginal propensity to consume, but a lot of people, they're going to put the money in the bank, they're going to save it, or they're going to pay down debt, which is the same thing and improves your balance sheet. But what they're saying is, okay, thanks for the money. How do I know if I haven't lost my job? How do I know I'm not going to lose it next month? How do I know there's not going to be another epidemic? How do I know there's not going to be a rebound of this epidemic? I better save it. Well, if you save it, velocity is zero. And I like to tell people, remind people, $5 trillion times zero is zero. Meaning if you don't have velocity, you don't have an economy. So there's more, all this Austrian, neo-Keynesian, multiplier stuff does not apply. There are other reasons why it doesn't apply.
So net effect, we're looking at L-shaped with a really slow recovery after that. Probably.
Best case, it may be an L with a little, downward slope, but best case, you're looking at a recovery maybe in the third quarter with a lower compound annual growth rate than we started. So call it the new normal.
Okay, so two potential scenarios. Really bad deflation, depression-like scenario. What happens to gold? The other option is hyperinflation. Let's talk about that after what happens to gold. If they just can't rescue the thing and they have to get inflation, you and I've talked about this before, but for people who haven't heard it before, what does the government do? What is the last resort?
Well, I know the answer. I can get you all the inflation you want in about 15 minutes, but the government's not. First of all, the government doesn't understand how, and the government's not desperate enough to do it. But it can be done. Again, before this podcast, I was on a call with my friends in the national security community, and we're going through some of the things we're talking about. Taiwan, South Africa, Mexico, the Great Depression. They're all relevant. I said the greatest threat to national security might be deflation, because what does deflation do? It increases the value of debt. The real value of debt goes up. So we got 22 trillion of national debt starting out. Throw on, 6 trillion of additional national debt. We're expanding the national debt by 25% in a matter of months. All the debt since George Washington, up 25% in a couple of months. Debt to GDP ratio is going up. Deflation increases the real value of debt. The most valuable assets are Well, cash is actually one because the real value of cash goes up. Now, what about gold? So everyone says, okay, I understand that gold goes up in inflation. You show me some inflation, I'll show you a higher price of gold. But surely the opposite must be true. Deflation means a lower dollar price for gold. That is not true. The greatest period of sustained deflation in U.S. history was 1927 to 1933. The price of gold went up 75%, from $20 an ounce to $35 an ounce. Gold performs very well in deflation, obviously well in inflation, but people don't understand why it performs well in deflation. And there are two reasons for it. And one is if you're on a gold standard. The other one is if you're not on a gold standard, which we're not at the moment. If you're on a gold standard, when deflation overwhelms you and people are saving, they're hoarding cash, they're not spending, they're not lending, there's no velocity, you're desperate to get prices up. You want prices to go up and they won't go up. You can devalue the dollar against gold. And that's what Franklin Delano Roosevelt did in 1933. Mm-hmm. When I say the price of gold went from $20 to $35, it did because he said so. He was the president. We were on a gold standard, and that's what we did. Well, but that was not a gift to people who own gold. In fact, he actually confiscated all the gold before he did it. So the Treasury.
He took the gold first, then he raised the price.
And then he raised the price. So the ultimate inside trade. Nice going, FDR. But the point being, nothing happens in isolation. When the price of gold goes up 75%, guess what? Corn, oil, wheat, energy, agricultural goods, produce, wages, everything else goes up because it has to be a blanket across the, and it worked, by the way. 1933, in the middle of the Great Depression, was one of the best years in the history of the stock market because what FDR did worked. Okay, so he did it on purpose and it worked. Richard Nixon did it by accident, but it also worked. When he took gold off, when he broke the convertibility of the dollar to gold on August 15th, 1971, the price of gold went from $35 an ounce to $800 an ounce by January 1980. So in 9 years, you had about a 2,000, roughly 500% increase. What happened? The price of oil quadrupled. The price of housing doubled. Interest rates went to 15%. In other words, gold, FDR and Nixon, one purposely, one accidentally, grossly devalued the dollar against gold, and we got massive inflation as a result. It wasn't a response to inflation. It was actually intended to cause inflation, and that's what happened. Right now, we're in the grip of deflation. That data hasn't shown up yet. It's happening all around you. It's going to get a lot worse. So if you were on a gold standard, somebody would go to the president and say, you need to devalue the dollar against gold. Bingo. We're not on a gold standard. What happens? Well, the price of gold also goes up, not because the government is forcing it, but because people are looking at the dollar saying, get me out of here. Mm-hmm. You don't have a PhD in economics. So Alex, the Fed's balance sheet, it went from 800 billion to 4.2 trillion between 2008 and 2014, which it did. Try 5 trillion, 6 trillion, 7 trillion. Mm-hmm. That's what's happening in front of our eyes. Yeah. And people are going to say, get me out of here. Get me a house, land, commercial real estate, gold.
Hard assets.
Get me out of the dollar, get me into hard assets because I don't know what's happening next, but I don't want to lose my money.
Yeah, I saw an article from Goldman Sachs, their head of commodities globally is banging the table, calling gold the money of last resort, telling everybody they need to buy it. It's amazing what's happening.
Well, you and I were suggesting people buy it at 1,100. So we're about 4 years ahead of Goldman.
It's amazing. Like everything we've talked about over the years, it's all happening right now. It's
correct.
It's all happening. Okay. So practical applications. What can people do? Let's break this down into chunks. The first chunk, average person, they're paycheck to paycheck. They have no assets. All this stuff comes down. Everybody's recommended that they stay home. They're probably thinking, how do I pay rent? How do I buy food? You have any thoughts for those people?
Yep. Go down to your local bank and get a small business administration loan right now. They got, I don't know the exact number, but it's order of magnitude is $100 billion through the Small Business Administration for small business. Now, small business is defined as anyone less than 500 employees. You don't have to be a local shipping company. You can be a flower shop, a pizza parlor. And a lot of people either don't know this because they haven't heard about it or they don't think that they somehow qualify. You qualify. Yeah, there's a little bit of paperwork. By the way, this is just literally happening in real time. But there are two criteria for it. One is to maintain payroll, and two is to pay the rent. The two most important expenses most businesses have. And here's the deal: you get the loan. If you don't lay anybody off, you can keep it. You don't have to pay it back. It's a grant. If you lay people off anyway, you have to pay it back. The interest rate is rock bottom. It's a long-term loan. But as long as you keep your employees, you can keep the money. What are you waiting for? You have to make sure your bank is an SBA approved lender, but they all are. By the way, the banks, just to be clear, the banks get a 5% origination fee. So if you take $1 million loan from the SBA, the bank gets $50,000 as an origination. So they want to give you the money.
Right.
The government wants you to have the money. This is not like people are afraid of banks. This is not like a normal loan. Like, oh gee, they hate me. I got to fill all this. They want to give you the money, and they want to do it as fast as possible.
I saw this crazy article last week. This guy started an airline and he called it bailout flights.
Yeah. Well,
he's maybe request $10 million. There was like 25 new airlines started just last week.
Yeah, well, look, some people have better lawyers than others, but I'm telling you, I don't care if you're a flower shop or a pizza parlor, you qualify, and if you don't fire your employees, you can keep the money. So it's based on payroll and rent, but it's the only kind of loan where the bank's actually on your side.
Okay.
Because by the way, the banks are guaranteed by the government, so they don't care about your credit because they're backstopped by the government. So,
right. So anything else that the average person can do? Rent,
if you
paycheck to paycheck, wondering about paying rent, buying food.
Yeah. Well, have a look at your 401k if you have one. I don't think I don't think the stock market's hit bottom. A lot of people are nibbling. We're off the bottom. Of course, your typical financial advisor who is usually thinking about themselves, not you, is saying, hey, ride it out. It'll come back. Well, okay, so 2008, it went down by, I think about 60 or 70%, almost about two thirds. Did it come back? Yeah, but it came back by 2014. 6 years is a long time to break even, which is what happened. And there were opportunity costs associated with that because you could have been in other asset classes. But I said at the beginning of this, Alex, that this is more like 1929. Okay, so the stock market crashed in 1929. Do you know when it regained the 1929 level? 1954. It was 25 years. It did come back, but it took 25 years. And I guarantee a lot of those people in 1929 were dead by then. So you can get out, go to cash, maybe a slice for gold. I've always recommended 10%. Don't go all in. A slice for gold, and then say, well, what if the stock market starts to go up again? Well, watch it. If you really see that, and it's not just a 2-day bounce or something, you can still jump in. And if you miss a little bit at the beginning, think of it as the price of a put option. You avoided a worse outcome.
So hard assets. So people with some assets, hard assets. Okay, small and medium business owners that are not in the USA and can't basically go get any thoughts?
SBA loans, yeah. Good luck. Go see. It depends on the country. Canada, Canada's mailing out checks. So it kind of depends on the country. Some people have nothing, and other people have programs as good or maybe even better than ours.
All right. So closing up, last thoughts here. I'm just going to open the floor to you. What do you want to talk about? Is there anything?
Yes, I would say that don't believe that I'm not. People say I'm a doom and glimmer. I'm not. I'm a realist and a pragmatist, and I have pretty good analytic models. A couple of things. Number one, you have to reset the outcome of the presidential election at 50-50. That's a reset. I had Trump as a 74% favorite about 6 weeks ago, which he was based on the model. I have to, I don't make it up. But it was conditional on a recession, no recession. And the odds of a recession at the time were less than 20%. So Trump's odds are 80% or higher, somewhere in that neighborhood. Well, now the recession's here. We're in a depression. Does that mean Trump has a zero chance? No. The reason is that no one blames him for this. They will
Well,
assess his
some people
handling.
are blaming him for this.
Well, yeah, okay, but they're not going to vote for him anyway. So, but most Americans are a little more fair-minded. They're going to judge Trump not by the fact that this happened, because it wasn't his fault. They're going to judge him by his response, by his
yeah, I
leadership.
agree.
So I reset at 50-50 and I'm watching, but that means that Biden has a 50% chance. So the market has not repriced for President Biden. They've kind of repriced for coronavirus. They're trying to reprice for the economy, but it's a moving target. The market has not even had time to think about President Biden, but that's another leg down if that gets a little traction, which it is. Number one. Number two, just be wary of what they call sucker rallies. Again, they said, the stock market was up 3 days in a row last week. The greatest 3-day rally since 1931. I was like, yeah, that's true. But the market bottomed in 1932. So your 3-day rallies don't get you off the bottom necessarily. Help your neighbors. That's probably the best thing we can all do. We're all in this together. It's a cliche, but it's more than a cliche. It's a reality, and
It's real
reality.
right now. Yeah.
So maybe I'll leave it at that.
You think Biden has dementia?
Biden has pretty clearly exhibited a cognitive slowdown, but that's not a good thing in a presidential candidate.
The optics are not good on that. No.
You can't think of a more stressful job. He's not fit, in my view. I'm not a doctor. I'll leave it at that. But it's pretty obvious what's going on. Is the Democrats didn't want him, but he powered through against a much weaker field. Then they had to want him because they needed to run Bernie Sanders off the road, which they did. You can't have a communist as your Democratic nominee. So mission accomplished as far as destroying Sanders. But now they're like, oh, this is who we have. Here's a wild card, but maybe not so wild. Of course, everything on the Democratic side is highly manipulated by the Democratic National Committee and superdelegates and changing the rules. This is why Tulsi Gabbard couldn't get on the stage, et cetera. So here's what they'll do: they'll keep Biden on his resuscitator or whatever, but they'll let Bernie get just enough delegates that, combined with Elizabeth Warren, for example, Biden won't get the nomination on the first ballot. He'll have more delegates for sure, but falls short of the first ballot. Once you get to a second ballot, it's jump ball because all the pledged delegates are released. 700 superdelegates come in from the sidelines. They can do whatever they want, and they'll pick Andrew Cuomo.
All right. You heard it. I think we're done. Jim, as always, thanks a lot. Really enjoyed today's conversation. Stay safe up there.
Thank you, Alex. You too.
You have been listening to The Gold Chronicles with Jim Rickards and Alex Stanczyk, presented by Physical Gold Fund. Recordings can be found at physicalgoldfund.com/podcasts. You can register there for news of upcoming interviews with Jim Rickards and other world-class thinkers.